Welcome to vTalkInsight, Allocator's Lens Daily for January 16th, 2026. Soft landing growth, an AI investment boom, and a sharp reset in energy prices are pulling markets in different directions across assets, while political noise around the Federal Reserve keeps policy risk firmly on the radar. Let's start with equities, where the tension between powerful earnings momentum and rising concerns about concentration and valuations is most visible. Equities remain the clearest expression of the soft landing narrative, with stable nominal growth near 5% and a resilient labor market, giving companies a solid revenue backdrop. Growth is being driven by affluent consumer spending, AI-related investment, and wealth effects from rising asset prices, all of which have proven less sensitive to high policy rates than traditional credit-driven demand. Against that macro setting, earnings expectations are robust, with forecasts for market-wide profit growth above 10% in 2026 and technology profits projected to grow at roughly twice the pace of the broader index. Within that, AI and semiconductors remain the epicenter of equity leadership. TSMC is guiding to roughly 30% sales growth in dollar terms and a record capital spending program above $50 billion, with capacity reportedly sold out through 2026, and the industry as a whole is expected to approach $1 trillion in annual sales with double-digit growth through 2027. This is feeding through to equipment makers such as ASML and Applied Materials at record highs, and to platform names like NVIDIA and Broadcom, where analyst estimates across the AI complex continue to be revised higher rather than lower. At the same time, the rally is clearly broadening compared with earlier in the week. Small caps have outperformed the S&P 500 for an unusually long streak. Equal weighted indices and value sectors are catching a bid. Banks are seeing strong investment banking and trading revenues, and non-U.S. as well as emerging market equities are outperforming after years of U.S. dominance. However, large-cap valuations, particularly for mega-cap tech and universal banks, are now described as stretched. Consumer sentiment is oddly weak despite solid data, and policy risks around credit card regulation, tariffs, and Federal Reserve independence hang over the tape, even as implied volatility in the mid-teens suggests a generally risk-on mindset. For allocators, the watch points are whether earnings breadth continues to widen beyond AI, how sensitive mega-cap growth proves to a higher for longer front end, and whether political and regulatory headlines start to challenge the current expectation of a fifth consecutive up year for global equities. In rates, the message is that the cutting cycle is likely to be later and shallower than markets hoped a few months ago. Headline inflation is drifting lower, helped by housing disinflation and cheaper energy, and there is confidence that U.S. inflation can trend toward roughly 2.5% by year-end without causing a recession. But wage growth for job stayers remains elevated. Non-housing services inflation, such as healthcare, is still sticky, and there are warnings that any erosion of Federal Reserve independence or a slide into fiscal dominance could reignite inflation pressures. That mix is feeding into a view that 10-year Treasury yields are likely to stay a bit above 4%, anchored by still strong nominal GDP, while the front end remains supported by firm labor data. Some investors still look for 2 rate cuts this year, often in the second half once a new Fed chair is in place, while others see a credible risk of no cuts or even a further hike if growth stays strong. Across scenarios, a much steeper real and nominal yield curve is a common theme, driven by high fiscal deficits and global fiscal expansion, with the Federal Reserve implicitly keeping yields within a range by reacting if they move too far in either direction. Overlaying the economics is politics. Statements from President Trump that leave open the possibility of removing Chair Powell, a pending Supreme Court case on presidential powers over Fed governors, and public investigations into the central bank all raise tail risks around policy credibility and term premia. At the same time, broad bipartisan support for the idea of Fed independence has so far reassured markets, keeping fixed income volatility contained even as front-end yields drift higher. For multi-asset portfolios, This rates backdrop supports current equity and credit valuations, but also argues for close attention to curve shape, fiscal news, and any sign that the political debate starts to bleed into inflation expectations. Credit markets are reflecting the same resilience seen in equities. Major U.S. banks report strong credit quality, with low delinquencies and charge-offs in both commercial and consumer books, and only a gradual normalization expected from very benign levels. Super-regional banks, such as PNC, U.S. Bank, and Truist, are viewed as relatively cheap compared with larger universal banks after a period of underperformance, supported by solid net interest income, buyback potential, and growing wealth management and fee businesses. Corporate credit spreads remain tight, and some expect them to tighten further against consensus, helped by a powerful pipeline of mergers and acquisitions and capital markets activity that is providing a valuation backstop for smaller or non-earning companies. The main areas of concern sit just outside the public bond markets. The explosive growth of private credit is increasingly highlighted as a potential financial stability risk, with questions over whether regulators have enough visibility into leverage and underwriting standards in that ecosystem. There is also policy uncertainty around proposals, such as capping credit card interest rates and swipe fees, which could pressure certain lenders and possibly dampen consumption at the margin, even if many observers see the most aggressive versions of those bills as unlikely to pass. For allocators, the credit story today is one of broadly supportive fundamentals and ample liquidity, tempered by the need to monitor where stress might first emerge if growth slows for lower-income households or if private credit structures are tested by a shift in the rate environment. Currency markets are caught between the reality of U.S. economic resilience today and the prospect of easier policy later. The strength of U.S. growth and still elevated front-end yields have kept the dollar firmer than many expected, especially versus economies where data and policy are softer, and that has been a key driver of FX moves in recent months. Looking forward, though, many expect dollar weakness to intensify once the Fed is clearly on a cutting path, particularly if other central banks prove less willing to ease than current pricing implies, and that is a key plank in the constructive narrative for non-U.S. and emerging market assets. Against that backdrop, the Japanese yen stands out as a pressure point. Technical work suggests a trend of continued yen weakness, and levels around 160 per dollar are already raising the risk of official intervention, which matters for global carry trades and risk sentiment more broadly. At the same time, emerging market currencies are supported by improving policy frameworks and high real yields in countries like Brazil and Colombia, while central banks continue to diversify reserves toward gold, reinforcing longer-term de-dollarization themes. Crypto assets sit on the edge of this discussion, with momentum toward a clearer U.S. market structure bill, even if political disagreements have delayed final agreement, and with some investors viewing fully reserved stablecoins backed by short-term treasuries as an alternative cash like store of value in a risk-off episode. Commodities add another layer of nuance to the macro picture. Crude oil has sold off sharply, dropping over 3%, and at times nearly 5% to below $60 a barrel as immediate geopolitical risk premium around Iran has been unwound. Beyond the headlines, supply dynamics look comfortable, with robust U.S. shale production and new South American barrels pointing to structural oversupply and a broadly bearish medium-term view on crude. Even as the depleted U.S. Strategic Petroleum Reserve represents a source of potential demand if policymakers choose to rebuild it at lower prices. From an equity angle, the energy sector remains a small slice of the S&P 500 and is highlighted as a contrarian opportunity, particularly in midstream names offering attractive yield spreads, while companies like Exxon continue to outperform over the cycle thanks to diversified businesses beyond just crude. Precious metals tell a different story. Gold is seen as enjoying structural support from central banks diversifying reserves away from the dollar and from investors seeking hedges against geopolitical and banking risks, even as overall risk appetite in equities remains strong. Silver, by contrast, looks much more speculative, with prices having roughly doubled in a short period before pulling back, aggressive calls from some market participants for very high price targets, and evidence that recent swings are being driven more by technical factors and hedging flows than by fundamentals. Volatility in silver, alongside still elevated gold prices, underlines how much latent demand there is for insurance against policy mistakes and geopolitical shocks. Finally, the commodity complex is being reshaped by geopolitics and resource security strategies. U.S. tensions with Iran, shifting military commitments, and disputes that could delay trade deals, such as those linked to Greenland, all sustain a background risk premium, even if the immediate oil shock has faded. At the same time, bipartisan moves toward a strategic reserve for critical minerals and plans by large U.S. financial institutions to commit well over $1 trillion to allied supply chains and security-sensitive sectors point to sustained capital flows into energy infrastructure and materials linked to the energy transition. For allocators, the key is how this mix of cheaper oil, structurally supported gold, and targeted investment in critical resources feeds back into inflation expectations, regional growth differentials, and sector earnings over the next few years. Pulling it all together, the cross-asset picture points to a still supportive environment for risk, anchored by steady nominal growth, powerful AI-driven capex, and tight credit spreads, but increasingly complicated by steeper yield curves, political pressure on the Federal Reserve, and a more volatile commodity backdrop. Equities are broadening beyond mega-cap tech. Rates are pricing a slower and later easing cycle with higher term premia. Credit remains firm, but carries growing private market risks. The dollar sits between current strength and prospective softness, and commodities combine a bearish oil reset with structurally strong gold demand. For allocators, the focus over coming weeks is likely to be on whether earnings breadth continues to widen, how the curve reacts to incoming inflation and fiscal news, and whether policy headlines around the Fed or geopolitics start to challenge today's relatively calm volatility regime. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.